Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
This is a quote of yours. It says, "No one is coming to save the market. And this time, if they try, it will only create a currency spiral." Pavlovian buy the dip investor conditioning worked because money printing bailed out every dip. That's over for now, and that's a huge deal. Want to tell us what you meant by that?
So it's an interesting one because, we've always talked, even on all of our last conversations, we've talked about this issue of fundamentally, what is the key ingredient to create a bubble like this? And it's always an inappropriate amount of money printing. This money printing that outpaces the economy means that you end up with more flows going into financial markets, and therefore this disconnect between, let's say, market caps to GDP or asset values in general, PE multiples, stuff like that. And that's true. That remains true. The issue with this bubble is it's gone for so long and it's gone so far, and it's brought so many different investors in from really every type of player. Every country has this huge concentrated exposure, not just to the US and US stocks, but to even very concentrated stocks within the US market cap. And it's almost like people are treating US stocks as their risk-free exposure. And that's switched from having treated treasuries or something with duration and fixed income as more like a ballast in their portfolio. And so what I mean by that quote is last year, around April, money printing stopped in the US. And shortly after that, it stopped in pretty much every other global central bank. So the BOJ stopped in August and started QT. The Chinese have been really pretty slow on printing relative to their domestic problems. ECB's been contracting, BOE's contracting, and so on. And so the point is, this is like the first time in 40 years that no central bank anywhere has been buying US bonds in particular, including the Fed, and a global-based money contraction. And yet from July onwards, for the second half of last year, the US equity market still went up. And there was two reasons for that, right? One of them was, people, as I say, bonds just had the worst drawdown since the 1860s. So people are reticent to take up a lot of the duration supply that started to be issued again in the second half. And so you had this mix initially out of bonds and into stocks that in a zero-sum environment helped keep pushing stock valuations up. Then you had foreigners come in as Europe was doing badly over the course of let's say August, September, growth-wise, they had a big hit from China in terms of the growth ripple hitting them first. And so equity investors moved from Europe into the US. And then finally, just when you think there's nobody left or it can't really go much further, in the last 3 months of the year, we had the biggest buildup in financial leverage going into the equity market since the late 1920s. And so that included all types of leverage. It was options, equity repo, bond repo. And so that as a flow, that was 4% of GDP in the second half of last year. So you had this huge money-driven bubble, and then you had leverage on top of that. And that blow-off top ended in December, year-end, cut the leverage. And so the market started to weaken, bounce back in January. And then ultimately, what's interesting now is that money printing, when it happens, it crowds out that leverage. So because the equity market became so dependent on leverage, or when people were issuing bonds, investors were using leverage to buy those bonds so that they didn't have to sell their equities. So investor gross exposures were increasingly levered. So you can think about it a number of ways, and it was different people. But the point is that we took on so much leverage that we maxed out not just the US banking system, but essentially all the global primary dealer systems in the world. And so now when there's money printing, which there has been this year because of the debt ceiling, that is sort of crowding the field a little bit in terms of these bank balance sheets that are already full of low risk or let's say cash-like exposures, whether it's repo or bank reserves or T-bills or treasuries or whatever. There's just too much of it. There's been too much money printing, debt issuance, particularly on the fiscal side. And now whenever there's TGA drain or money printing, it actually squeezes the banks rather than providing like a fresh source of ammo for the bubble to continue. And meanwhile, obviously, foreigners are reevaluating the whole position that they have, right? So they're an incremental drag on that as well. So I meant that in a very technical way when I wrote that, but it's true when you think about the policy response too. And from an economic perspective, I think that's probably the more important thing, which is that this is going to be the first recession, and we think we're literally already in it. This is the first recession where the US has backed itself into a corner of not being able to do fiscal stimulus in a downturn, not being able to really do money printing in a downturn without actually creating some sort of currency pressure. And you're almost like trying to fill a bucket that's got a hole in it. So they can do it, but it's not going to be particularly effective. So my point is just that highest valuations across pretty much all metrics since the late 20s and this hugely concentrated and now leveraged investor positioning. Okay, we're going into a meaningful downturn without the ability to ease both fiscally and monetarily. And that's a new thing that the US is not used to, but also the balance sheets being as large as they are in terms of the debt loads and so on are not really attuned for that sort of economic volatility without a cushion, which is what we're going to experience.
All right. Well,
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.